interest rates, these quote crazy interest rates that are still historically low. Yeah, let's go over one. This is like I'm gonna round the numbers off because I don't like all the numbers that are on this. But let's use a $400,000 property with a $100,000 down payment. Okay, so that's 25% down for anybody out there who didn't know. That's what that is. And after all expenses, including the crazy mortgage payment, you know, where we got this insane high interest rate, even after all of that, property cash flow is almost $700 a month. Okay, so after you pay the management company and the HOA and everybody gets paid $700 a month cash flow. Okay, which is a decent cash on cash return. It's 8%. Okay, now again, I'll go back to the original example. Where else can you get an 8% dividend on your money?
Yeah,
I don't know any other investment that gives you that, but there it is. Now, in addition to that, Heather, there's someone living in the property paying your mortgage. And this is one that's overlooked a lot, but this is actually pretty big. This is not just a little insignificant thing. Someone is paying down principal, creating equity for you every single month.
Mm-hmm.
That works out to a little over a 4% return. Okay.
And I think we should go over too that if the market does go down, right? So say you bought this house at 400, the tenant is paying down your mortgage, giving you equity. What if you lose a little bit of value in this property? You have equity in there that wasn't even paid for by you, which is pretty cool.
It's a beautiful thing, and the market will recover anyway.
Yeah.
So just hold on to it while you have to have your measly little 8% return. And your measly little 4% return, and then the measly little tax break you're going to get that's going to give you almost 3%. Those three things right there, those just continue to happen, right?
Yeah.
Throw appreciation completely out the window because, as Heather said, maybe it goes down in value.
Mm-hmm.
But those three things are going to happen. So that's, what is that? 16%?
Yeah, close to.
I mean, folks, I'm not sure where else you're getting 16%, consistently getting 16%. But that's what this is. So you're getting about $8,300 a year in cash flow. You're getting about $4,200 a year in principal reduction, in equity gain from somebody paying down your principal. And you're getting a $2,800 tax break, and that's if you don't accelerate the depreciation. That's straight line depreciation.
Yeah,
if you
and
accelerate it, it's even better.
Yeah, and on this particular property, you have two tenants. So if say you have a vacancy, because you'll have, there's always things that can go wrong in real estate too. So say you have a vacancy, you should have one tenant on the other side still paying, so covering most of your expenses in owning the property, right? A good chunk of them at least. So that way you don't have to have that as a stressor, which is great. And then this particular property we're talking about built in 2014. So it's not an older property that you're going to have potentially a lot of expenses on. You could still have expenses on a property built in 2014 for maintenance, but wouldn't be as high as a property built in 1950. So
yeah, I mean, so that's the reason people buy them. It's because when you buy a stock, let's say the stock market actually is down sufficient that that now is the time to buy, and be bullish, and the market's going to recover, and it's going to you're going to make a ton of money. That may happen, but you're only going to make one type of money. There's only one type of return there.
Mm-hmm.
It's a capital gain. That's it. It's either going to go up or it's going to go down. And that's why people are so concerned when the market gets volatile. Well, when the real estate market gets volatile, the thing that's going up and that's going down is the value of the home or the value of the property, which is not really, now I'm speaking about non-commercial properties right now. Okay. So 1 to 4 family units. It's not relevant. Fannie Mae doesn't give a crap. Mm-hmm. She doesn't care unless you don't make her payments. Okay.
Yep.
Doesn't care. Guess what? The house doesn't care. Doesn't get its feelings hurt. Nobody knows the difference. Nothing changes. So your
Yep.
cash flow doesn't change. Your principal reduction doesn't change. Your tax reduction doesn't change, unless, of course, the politicians change it. But
Yeah.
anyway, those three things don't change. The only thing that changes is appreciation, is the gain, which is the only thing when you're investing in the stock market that you're going to get anyway.
Yeah.
Okay. So you're getting 3 additional returns. Those returns are what makes real estate so sexy, because when you add all of them up over time, they kick the pants off of anything else I've seen.
And even when you have big expenses and issues like that, I helped a client with a portfolio this week. He said, "Man, Heather, I've had to put a deck on the back of a house, and I've had some capital expenditures too, which you can write off on your taxes." But we did a deeper dive and looked at his property values, and I said, "Man, you have some great gains on 2 of your 6 properties. Well, 3 of your 6 properties, but 2 were crazy good." And I said, "Why don't we liquidate these and sell them?" And because we would do that regardless of how his whole portfolio was performing. So it's just magic that there's 4 different ways to make money. That you can have gains that help offset losses, and it's not just cash flow is your only source of income, which is super cool.